You landed a $500K remote job and moved to a city where rent is just $800 a month. The math seemed perfect. A six-figure software engineer earning San Francisco salaries while living in rural Mississippi should be a recipe for wealth building. But then tax season arrived and you discovered something nobody warned you about. Your net take-home just dropped by $180,000 due to taxes you didn't budget for. You're facing a nightmare scenario where your dream job actually made you poorer than before. This is the geography arbitrage trap, and it's catching thousands of remote workers off guard. The strategy is simple on paper: earn top-tier coastal salary, live in a low-cost region, pocket the difference. But the reality is far more complex, and the hidden costs can wipe out years of savings. According to a 2023 Flex Jobs survey, 38% of remote workers who relocated reported financial regret within the first year, primarily due to unexpected tax obligations they didn't anticipate. This is Career Capital Research. We're analyzing real compensation data, IRS tax law, and employment trends to show you exactly how the math breaks down, and where remote workers are losing money they don't even realize they're losing. By the end of this video, you'll understand the true cost of geography arbitrage and how to actually make it work. The geography arbitrage promise, where IT looks good. Let's start with why geography arbitrage seems so attractive. The foundational concept is straightforward. The cost of living varies dramatically across the United States. According to the MIT Living Wage Calculator, a single adult in San Francisco requires approximately $54,000 annually to cover basic expenses: housing, food, transportation, healthcare, and childcare. The same person in rural Mississippi needs only $27,000. That's a difference of $27,000 per year, or 50% less. Now layer in salary differences. A senior software engineer at a major tech company in San Francisco might earn $400,000 to $500,000 in total compensation. If that same engineer works remotely from Mississippi, they keep that same $400,000 to $500,000 salary. On paper, the arbitrage opportunity looks like $200,000 plus in annual wealth accumulation. This isn't theoretical. There are legitimate success stories. Take Sarah, a product manager who accepted a remote role with a $350,000 base salary plus $50,000 annual bonus from a New York-based fintech company. She relocated to Asheville, North Carolina, where her mortgage was $1,200 per month instead of $500. For the first 6 months, she felt like she'd cracked the code. She was saving $40,000 per year on housing alone, and her expenses were dramatically lower. The appeal extends beyond just cost savings. Geography arbitrage promised freedom: work for prestigious companies, access global salary standards, build wealth faster, and do it from anywhere. Digital nomad blogs, YouTube channels, and social media influencers celebrated it as the ultimate career hack. Earn $100K plus working remotely in countries with $15 rent. The clickbait promised: build your escape from the 9-to-5 rat race. But Sarah's story has a plot twist we'll return to later. The hidden tax catastrophe, where the math breaks. Here's where most remote workers get blindsided. Taxes aren't simple geography-based calculations. The actual rules are governed by two critical factors: 1, where your employer is based, and 2, where you physically perform your work. Most large tech and finance companies are based in high-tax states like California, New York, and Massachusetts. When you accept a remote role at a Silicon Valley company, the employer's payroll system is typically configured for California taxation. But here's the critical detail: if you're performing work in a different state, you may now owe state income tax in both your employer's state and your residential state, a situation called double taxation. Though it's technically not double taxation, but rather requires careful tax planning. Let's work through Sarah's actual numbers. Her $400,000 total compensation breaks down as $300,000 base salary, $50,000 annual bonus, and $50,000 in stock options vesting annually. The employer withholds taxes as if she's working in New York. New York's top marginal state income tax rate is 82%, plus federal income tax at 37%, plus FICA taxes at 3%. That's roughly 61% in total withholding. But Sarah moved to North Carolina, which has a flat 99% state income tax. She thought she'd get refunds on that differential. Instead, she discovered that some states consider her a resident based on physical presence, while New York's employer still withheld based on their state rules. She had to file tax returns in multiple states, pay accountant fees of $300, $500, and ultimately owed $42,000 in unexpected taxes because the withholding didn't align with her actual state residency. But let's examine an even more catastrophic scenario: the $500K salary earner who moved to a state with no income tax. David, a senior engineer, landed a $500K role at a Silicon Valley firm and relocated to Austin, Texas, which has 0 state income tax. He assumed he'd save roughly $40,000, $50,000 annually on state income taxes. instead. He discovered that California claims he's still a resident for tax purposes because A, he had property in California, B, he had a California driver's license, and C, his employer is California-based. California's Franchise Tax Board, according to a 2022 audit analysis by tax attorney Mark Statsky, has aggressively pursued out-of-state remote workers, claiming they are still California residents and owe full California taxes. David ended up owing $47,000 in back taxes plus penalties and interest. His geography arbitrage dream cost him money. The withholding and residency nightmare. The second hidden trap is how payroll withholding actually works. When you're hired for a remote role, the company's payroll system asks one question: where will you be working? If you say state X, the payroll system withholds state X income taxes. But if you move to state Y mid-year, without updating payroll, you're creating a tax mismatch. According to data from the American Payroll Association, 47% of employees who relocate for remote work don't update their W-4 or state tax withholding forms with their employer for 90+ days. During that lag time, they're underwithheld for their actual state, creating a tax bill surprise in April. Consider Michael's situation. He accepted a remote role at a New Jersey firm earning $350,000. For 6 months, his payroll withheld New Jersey taxes, roughly 85% marginal rate. He then relocated to Florida, no state income tax, and updated his withholding. He thought he'd get a refund for the New Jersey taxes he'd overpaid. But New Jersey has convenience of the employer rules. If your employer provides you the convenience of working from home, you still owe New Jersey state income tax, even if you live in Florida. Michael ended up owing $8,500 because he wasn't eligible for the out-of-state withholding refund. Case study. The $180K surprise. Let's return to our original scenario with actual numbers. Jordan accepted a $500K remote role, $350,000 base, $100,000 bonus, $50,000 in annual stock vesting. He relocated from San Francisco to rural Mississippi, where rent is $800/month versus $4,500 in the Bay Area. Expected calculation: save $44,400 per year on rent alone, plus lower utilities, food, and services. Actual calculation: 1. Federal income tax $500,000 times 37% marginal rate equals $185,002. FICA taxes $500,000 times 15. 3% equals $76,503. California state tax his employer is based there. $500,000 times 9. 3% equals $46,504. Mississippi state tax Mississippi has no state income tax, but because his employer is California based, he may owe California taxes regardless, plus $46,500 or $0, depending on residency rules. 5. Self-employment tax on stock $50,000 times 20% equals $10,000 in certain scenarios. 6. Accountant fees $4,000 for multi-state tax planning. 7. Unexpected quarterly payments if withholding is miscalculated. Penalties of $2,000, $8,000 total tax liability. Roughly $370,000, $380,000, leaving him with $120,000, $130,000 net after taxes. That's a 24-26% take-home rate versus an expected 45-50%. The gain from moving to Mississippi is now $44,400 rent savings minus $10,000 accounting fees minus $50,000 plus unexpected tax liability difference equals net negative $15,600. Jordan didn't get richer by moving to Mississippi. He got poorer despite the lower cost of living. The healthcare and benefits trap. There's another hidden cost that compounds the problem. Most remote workers assume their employer health insurance follows them anywhere. Technically true, but with complications. When you change your tax home for IRS purposes, you may no longer qualify for the same health insurance subsidies and deductions. If you're self-insuring or using an ACA marketplace plan, your premiums can skyrocket. Premiums for a 40-year-old individual range from $200/month in Mississippi to $600+/month in California. But there's a critical detail. If your employer is still based in California and you're a remote employee, you may be required to stay on the California-based health plan even if you're living in Mississippi. Moreover, if you're an independent contractor 1099 employee, rather than a W-2 employee, you lose employer-contributed health care and must pay self-employment tax on 100% of your income instead of the employer covering half of FICA. That's an additional 3% tax hit. Where geography arbitrage actually works. Now, before we paint this as an entirely failed strategy, let's be clear. Geography arbitrage does work. It's just not as simple as earn California salary, live in Mississippi. It works for specific types of people in specific scenarios. **** Scenario 1. Full remote companies with true location-neutral pay ***. Some companies like Automatic WordPress Owner, Zapier, and GitLab are truly location-neutral. They pay based on job level and experience, not location. If you work for one of these companies, you keep your salary even when relocating, but the company withholds taxes based on your actual location. This makes geography arbitrage predictable and tax efficient. *** Scenario 2. Contractors and 1,099 employees with tax strategy ***. If you're a contractor earning $500K per year, you can actually optimize your situation. You can incorporate an S-corp in a low-tax state like Nevada or Delaware, manage your own withholding, and potentially save $40,000, $80,000 annually compared to W-2 employment. But this requires sophisticated tax planning and should only be done with a CPA. *** Scenario 3. Relocating to zero-tax states with proper documentation *** if you move to Florida, Texas, Nevada, or Washington, zero-state income tax states, and you update your driver's license, update your voter registration, spend 183 plus days per year in that state, don't maintain property or ties in your previous state, work for a company that allows out-of-state employees, then you can legitimately avoid state income taxes. But the burden of proof is on you. If California audits you and you can't prove residency, you'll owe back taxes. ***. The expert perspective *** CPA and tax attorney Michael Gerber, who specializes in remote worker taxation, states, "The biggest mistake I see is remote workers assuming tax liability will be simple. They're not budgeting for state tax returns, multi-state filings, and penalty interest. By the time they realize the issue, they're facing $30,000, $100,000 in unexpected bills. The solution is to plan before you move, not after." According to the 2023 IRS Remote Work Survey, 62% of remote workers who relocated to a different state didn't file all required state tax returns in the first year. That's a compliance failure that can result in penalties of 20–25% of the unpaid tax amount. ***. How to actually make geography arbitrage work ***. 1. Before accepting the remote role ***. Ask the employer how they handle multi-state taxation. Do they withhold based on work location? Can you work from multiple states? 2. Consult a CPA before moving ***. Spend $500 $500 for tax planning consultation. A CPA can model your actual tax liability based on your specific situation. 3. Establish true residency ***. If moving to a zero-tax state, maintain that residency through documentation: driver's license, voter registration, bank accounts, primary residence. 4. Update payroll immediately ***. The day you move, update your employer's payroll system with your new address and state. 5. Set aside 40% of income for taxes ***. Instead of assuming 30% tax liability, assume 40–45% and invest the difference. You'll either have a pleasant surprise at tax time or you'll be prepared. 6. File all required returns ***, even if you think you don't owe a particular